You have spent the last 30 or 40 years of your life climbing a massive financial mountain. You have skipped vacations, you have maximized your contributions every single year, and you have stared at your retirement dashboard every night, hoping the numbers would eventually be enough. Now, here we are in January 2026, and you have finally done it. You have officially retired. You are ready to flip that switch from saving money to spending money. But I need you to stop right now. I need you to put down that withdrawal request form and listen to me very carefully, because we are entering what I call the 401k death spiral. Most people think the hardest part of retirement is reaching that magic number. They think once they hit $1 million or $2 million, they are safe and the work is done. They are wrong. The most dangerous mile of a marathon is the last one, and the most dangerous year of your entire financial life is your very first year of retirement. The rules of the game just changed while you were busy packing up your office desk and saying goodbye to your coworkers. Compared to just 1 year ago in 2025, the year 2026 is a completely different beast for your wallet. Last year, we were still riding the tail end of the old tax structures. But now, as you prepare to file your first Form 1040-SR, which is the specific tax return designed for seniors, you are going to see numbers that should honestly scare you. For 2026, the standard deduction for a married couple filing jointly has moved to $32,200. While that sounds like a good thing compared to the $31,500 we saw in 2025, it hides a much darker reality. The sunsetting of previous tax cuts and the implementation of the One Big Beautiful Bill provisions mean your effective tax rate on every single dollar you pull out of that 401k is likely much higher than you ever projected when you were in your 50s. If you pull out too much money too fast in this specific 2026 macro environment, you are not just spending your money. You are murdering your future purchasing power. Let me introduce you to Bob and Sarah because their story is likely your story. Bob is 66 and Sarah is 64. They have $1.8 million in a traditional 401k and about $200,000 in a regular savings account. They have been told for decades about the 4% rule. Bob thinks that since it is 2026 and he is finally retired, he should be able to take out $120,000 this year. He wants to do a big Mediterranean cruise, pay off the last of their SUV loan, and just finally start living the dream. Bob thinks he is being conservative because $120,000 is only about 6.6% of his total nest egg. But Bob does not see the invisible tax cliff. By pulling that $120,000 on top of their Social Security benefits, Bob is about to trigger a sequence of events ranging from Medicare surcharges to the tax torpedo that will cost them an extra $18,000 in unnecessary losses in just the next 12 months. If they keep this up, their $1.8 million will not last 30 years. It will be gasping for air in 14 years. That is the death spiral. Today, I'm going to break down the 4 massive mistakes that are causing retirees to bleed cash right now and show you the exact math you need to survive. The first mistake is the tax torpedo, and it is deadlier in 2026 than ever before. Many of you assume that because you are retired and your salary has stopped, your tax rate will automatically drop. This is a dangerous hallucination. When you pull money from a traditional 401k, the IRS treats every dollar as ordinary income. But it gets worse because of how that income interacts with your Social Security. In 2026, the thresholds for taxing your benefits have not been adjusted for the massive inflation we have seen over the last few years. If you are like Bob and Sarah, you are looking at a combined income of $120,000 from the 401k plus another $50,000 in Social Security benefits. To the IRS, your combined income is calculated by taking your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. For Bob and Sarah, that math looks like $120,000 plus $25,000, which equals $145,000. Here's the trap. Once a married couple exceeds $44,000 in combined income, 85% of their Social Security benefits become taxable. This means $42,500 of Bob's Social Security is now being taxed as if it were a paycheck. Bob is effectively being double taxed on his retirement. Because he pushed himself into a higher bracket, he is losing a massive chunk of his purchasing power before he even finishes his first year of retirement. In 2026, the tax brackets have shifted such that the jump from the 12% bracket to the 22% bracket happens faster than you think when you factor in these additions. Bob thought he was in the 12% bracket. But when you calculate the tax on his 401k plus the newly taxed Social Security, his marginal tax rate on those last few $1,000s is actually closer to 40%. You cannot afford to lose 40 cents of every dollar to the government just because you did not time your withdrawals correctly. Before we go any deeper into the second mistake, I need to ask you for a quick favor. If this breakdown of the 2026 tax reality is helping you understand your own retirement better, please hit the like button right now. It tells the algorithm that this high-level financial data is important for other retirees to see. And if you have not subscribed yet, you need to do that and turn on the notification bell. We are in a period of massive legislative shifts with the One Big Beautiful Bill and Secure Act 2.0 updates, and I am documenting every single change to the tax code and withdrawal limits as they happen this year. By subscribing, you are making sure you don't miss the specific form numbers or deadline changes that could save you thousands. Go ahead and hit that button and let's get back to the math, because the second mistake is the Medicare premium trap, also known as IRMAA. The income-related monthly adjustment amount is a surcharge on your Medicare Part B and Part D premiums. It is based on your modified adjusted gross income from 2 years prior, but the 2026 thresholds are what you need to worry about today. If Bob and Sarah report that $120,000 withdrawal plus their other income, they are going to fly right over the initial threshold. For 2026, if a married couple's income exceeds $212,000, their Medicare premiums start to climb. Now, you might think Bob is safe since his $120,000 is below $212,000, but you have to remember that his total income includes the taxable portion of Social Security, dividends from his brokerage accounts, and any part-time work he did before officially retiring in January. When he hits that threshold, his Medicare Part B premium will jump from the standard $185 per month to $260 or more. For a couple, that is an extra $1,800 a year in pure expenses that provide zero extra benefit. It is just a tax by another name. And because Medicare looks back 2 years, the mistakes Bob makes in 2026 will come back to haunt him in 2028 when he might have even less money in his accounts. The way to avoid this is by managing your 401k withdrawals so you stay exactly $1 under those IRMAA tiers. If Bob had just taken $10,000 less from his 401k and used his cash savings instead, he would have saved nearly $2,000 in healthcare costs. That is a $2,000 return on investment just for doing a little bit of paperwork. The third mistake is the sequence of returns risk, and this is where the death spiral truly begins. We are currently in a high volatility market. If the market drops 10% while you are also taking out 6% for your living expenses, your account does not just go down by 16%. It loses the ability to ever recover. Let us look at Bob's $1.8 million again. If the market takes a 10% hit this year, his balance drops to $1.62 million. Then he takes out his $120,000. Now he is at $1.5 million. Most people think he just needs a 10% gain next year to get back to where he was. That is incorrect. To get from $1.5 million back to $1.8 million, he needs a 20% gain. Achieving a 20% gain in 2027 after a down year in 2026 is a massive gamble. This is why the first year of retirement is the most dangerous. If you sell your stocks when they are down to pay for your cruise, you are locking in those losses forever. You are essentially cutting off the limbs of your financial tree. Those shares you sold at a discount can never grow again. They can never pay you dividends again. This is how people who thought they were millionaires end up broke by age 75. They forced their portfolio to liquidate during a market correction. In 2026, with global economic shifts and the new interest rate environment, you cannot assume a standard 7% return every year. You have to be prepared for the sequence to be negative right at the start. The fourth mistake is the lack of a cash bucket and the trap of compensatory spending. After working for 40 years, you feel like you deserve to spend. You want to reward yourself. But in 2026, the cost of living is significantly higher than it was when you started planning this retirement 5 years ago. Prices are up nearly 20% across the board since 2021. If you are withdrawing based on old 2021 numbers, you are underfunding your lifestyle. Bob's mistake was not having a dedicated 2-year cash cushion. He is selling his 401k assets in real time to pay for his daily coffee and his monthly mortgage. This is a recipe for disaster. The correct strategy for 2026 is to have at least 24 months of your living expenses in a high-yield savings account or a money market fund before you ever stop working. This allows you to leave your 401k alone when the market is bleeding. If Bob had $200,000 in cash, he could have taken his $120,000 from there during this volatile year, letting his $1.8 million sit and recover. By the time his cash ran low in 2028, the market would likely have rebounded, and he could then resume his 401k withdrawals at a much higher share price. Instead, by selling now, he is participating in the very definition of the death spiral. Now, I want to talk about the solutions because you can absolutely avoid this. The first thing you need to do is master the withdrawal sequence. Do not just blindly pull from your 401k. You should be looking at your brokerage accounts first. In 2026, the long-term capital gains tax rate is still 0% for married couples earning up to $94,050. If Bob had sold stocks in his regular brokerage account instead of his 401k, he could have potentially paid zero federal tax on that income. Think about that. 0% versus 40%. That is the difference between a retirement of luxury and a retirement of stress. You also need to look at Roth conversions. Since the Secure Act 2.0 pushed the required minimum distribution age to 73, many of you in your mid-60s have a golden window. Between the ages of 66 and 72, your income might be the lowest it will ever be. This is the time to move money from your traditional 401k to a Roth IRA. You pay the tax now at the lower 2026 rates, and then that money grows tax-free forever. More importantly, it doesn't count as income for Medicare or Social Security taxation purposes later in life. You are essentially disarming the tax torpedo before it ever has a chance to fire. Another critical tool is Form SSA 44. If you have retired recently and your income has dropped significantly, you do not have to accept the high Medicare premiums that the government assigns you based on your old salary. You can file this form under the life-changing event category. Specifically, you check the box for work stoppage. This tells the Social Security Administration that your 2026 income will be much lower than your 2024 income. They will then adjust your premiums downward, saving you thousands of dollars immediately. Most retirees have never even heard of this form, and the government is not going to call you to tell you about it. You have to be proactive. You have to take control of these documents because every $1,000 you save on premiums is $1,000 that stays in your 401k and continues to compound. I also want to touch on the One Big Beautiful Bill and how it affects your deductions. For those over 65, you get an additional standard deduction. In 2026, this is $1,850 per person or $3,100 for a couple if you are both over 65. Make sure you are using Form 1040-SR to capture this. If you are using the standard Form 1040, you might miss these senior-specific line items that are designed to protect your income. Every little bit counts when you are fighting the death spiral. The combination of the extra standard deduction and the careful management of your AGI can keep your effective tax rate in the single digits, even if you are living a six-figure lifestyle. As we move through 2026, the landscape will continue to shift. I cannot stress enough how important it is to stay informed. If you found this math-heavy breakdown useful, please share this video with one friend who is also planning to retire this year. Most people are walking into a trap they don't even know exists, and you could be the person who saves their retirement. Send it to them via text or share it on your Facebook page where your former colleagues can see it. We need to get this information out there because the traditional financial media is still talking about the 4% rule like it is 1995. It isn't. The 2026 tax code is a maze, and you need a map to get through it. Before I leave you, I want to give you a specific action plan. First, go find your most recent 401k statement and your Social Security estimate. Second, calculate your combined income using that formula I gave you earlier. Adjusted gross income plus 50% of Social Security. If that number is over $44,000, you need to sit down with a tax professional or use a high-end retirement planner to model your 2026 tax liability. Third, download Form SSA 44 and see if you qualify for a premium reduction. And finally, look at your cash levels. If you don't have 2 years of expenses in a safe liquid account, you might need to reconsider the timing of your big purchases this year. You do not want to be selling your 401k assets in the middle of a market dip just to buy a car that will depreciate the moment you drive it off the lot. I know this feels like a lot of work. I know you just wanted to relax, but the effort you put into managing your withdrawals in this first year will determine if you can stay relaxed for the next 30 years. You have the tools, you have the math, and now you have the plan. Don't let the 401k death spiral take away everything you have worked for. Stay disciplined with your spending, be strategic with your taxes, and always keep an eye on those Medicare thresholds. If you have questions about the specific 2026 tax brackets or how the Roth conversion ladder works with the new RMD ages, leave a comment below. I spend several hours every day reading your comments and answering as many as I can. Your questions actually help me decide what topics to cover in the next video, so don't be shy. Tell me your situation, tell me your fears, and let's figure this out together. And if you appreciate this kind of deep dive, no-nonsense financial analysis, make sure you have liked the video and subscribed to the channel. I am here to be your advocate in a financial world that often feels like it is designed to keep you in the dark. One final thought for you. Retirement is not about how much money you have. It is about how much of that money you actually get to keep and spend. In 2026, the gap between those two numbers is wider than ever. But with the right strategy, you can close that gap and build a retirement that is truly secure. Thank you for watching. Thank you for being part of this community. And I will see you in the next video where we will dive even deeper into the specific investment allocations that are working best in this 2026 economy. Keep your head up, stay focused on the numbers, and remember that you have the power to protect your future. I will see you soon.